We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the CashFlowPro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of CashFlowPro, your daily real estate investing podcast and YouTube channel. I'm here today with Randy Langenderfer. Randy, how are you today, sir?
I'm good, Casey, and you got it right. There's not a lot of people that do that on the first blush, and we didn't even rehearse that before we got on the air, so thanks.
That's right, man. I usually, sometimes the only things that get me are like things that are like I'm very good at pronouncing out things, but it's something like where some weird combination of letters makes some funky noise. That's where I always get screwed up. So if it's usually typically just a straightforward spelling, I'm in good shape. So Randy comes to us with InvestArk Properties, and we were talking a little bit before the show, and we were kind of trying to get our angles right as to what we're going to dive into here. And I guess first off, Randy, why don't you tell us just a little bit about yourself so that the listeners have some context behind some of your stories and some of your thoughts, and we'll go from there.
Casey, let me first of all just say thanks for the opportunity to be on your show. It's a privilege, and I know you have a great audience, and looking forward to hopefully building some value into them along the way. But Randy Langenderfer, InvestArk Properties, as you mentioned, I'm located in Houston, Texas, as we speak, and I am. So I guess I fit a lot of the bills, and I like to say that I'm still self-employed. I'm self-employed, excuse me. I'm not self-employed. I'm still employed with a large academic medical center here in Houston. I'm a father of four. I'm a husband of many years. I'm a grandfather. My wife always gives me a hard time for not mentioning the personal stuff on these podcasts, so I got to make sure I get that plug in there for her. And
sure. Well, I want to point out too that you followed. You were telling how many you were a grandfather of and a father of, and then you got to I'm a husband of many, and I was like, I started to tense up a little bit there, and then you said years, so it carried it on through the fourth sentence. But I was like, husband to many. I didn't quite know. I thought maybe this podcast was going to take a little turn there. I wasn't sure.
A whole new area you weren't prepared to go down, huh?
yeah. We were going to start. Well, you raise your capital from all your wives or something like that. I didn't know. No, let's go ahead. I'm just messing.
That is funny. But I am so today I am employed, as I indicated. I started out doing single family hard money lenders in the single family flipping space. And so I started out and came to Houston back in 2013 from then Cleveland, Ohio. And I found multifamily and basically have never turned back. Fast forward to today, I'm a general partner or an active partner in about 1,100 doors. And over that time, I've been a passive investor in about 4,000 doors. So I really think I'm a better active or general partner because of my passive experience, and I really like to speak into those people. And also I speak to a lot of people that have been in the space for a long time or high net worth individuals that I know from the corporate world, and they say, I got passive income already, Randy. I got dividend paying stocks and bonds and all that stuff. And I said, yeah, but have you ever considered diversification, market diversification? So
Sure.
I tell the story that I'm getting off on a tangent already, but my employer has a $2 billion endowment fund here in Houston. And for the first time in about the last 3 or 4 years, real estate is actually called out as a line item as part of that diversification strategy for that endowment. Usually it's just.
I think we're going to see that. I think you're going to see that more and more in the coming years, because these syndication models are starting to become far more sophisticated. They're starting to become far more profitable. They're starting to become far more, because the one thing about I don't want to say dividends are completely like forecastable, but dividends for the most part you should be able to just about use some of the financial statements to project what you think those dividends are going to be. So they become they're truly passive, but they become somewhat projectable where you can say, hey, we think if we own this many shares of
Mhm.
X number of stock, we're gonna end up with the dividend payment of hopefully this much at the end of the year. And so as I feel like these syndication models become more sophisticated, don't you think that a lot more folks are going to start
Oh
having
yeah,
that line item because they are very forecastable, they're very projectionable, and so on?
I totally agree with you. I mean, I think again, we're preaching to the choir here, but you're right. And the other thing, there's for a long time I chased, from my own investment perspective, the aristocrats, which are those are the stocks over the last 30 years that have paid dividends consistently with an increase in
Mm-hmm.
value. They're called the aristocrat stocks, and many of them have fallen out of favor too, and on hard times. And so there's nothing guaranteed anywhere. But
Sure.
I think the cash flow from real estate, I mean, especially in this space, multifamily, everybody's got to live somewhere. And so
Sure.
it's not like, even if you're in office or retail, within the commercial real estate sectors, those may have more unpredictability. But I think you're absolutely right that it's just a matter of finding a good sponsor that has a track record and
Well,
can hit their pro forma.
and what I think you're going to see too is so real estate. Like I've been 100% real estate for 15 years up to my syndication beginnings. Like I'm talking about real estate sales, right?
Okay.
So real estate, but I also used to be Series 6 and 63 licensed. I had a Series 3 commodities trading license several years ago. So I've always been basic basically like looking at financial stuff kind of across the river, if you
Sure.
will. And I felt like when I started looking into syndications, and I'm going down this rabbit hole so that you can give me your thoughts and ideas and what you think. But I kind of looked at the syndication model as kind of like where finance guys meet real estate guys, and it's like and as they become one or as they become more intertwined with one another, you have financial guys who are going to become very serious real estate operators, and they're going to become more efficient the more time goes along. And it's like you said, everybody has to have somewhere to live.
Yeah.
So whether we like it or not, in an increasing in a increasing population that's basically for the most part, exponentially increasing, um, I just don't think it's ever going to fall off of being one of those line item diversification tools.
Well, so I'm a I'm a finance MBA. I'm a CPA, and I'm not going to profess I didn't have my Series 6 license like you did, and studied as much as you did. But
It's true.
Series 3,
You did.
sorry, Series 3.
Oh, I did have 6 and 63. I'm sorry, I was thinking Series 7. Never mind. Go ahead. Series 6. I did have Series 6, 63,
Well,
and
the
3.
bottom line is you're a lot more educated even than I am, so that's fine.
I don't know about that.
it's
I don't know about that.
it's it's just the macroeconomics. Once I got my head around, as a finance guy, I would say a professional or a finance accounting guy, I got my head around non-recourse debt, and that I can buy a multi-million dollar asset easier than I can get a mortgage on my primary residence. Why? Because it's
Yeah.
guaranteed by the asset, as we know now.
Yep.
That was the first thing for me. And then you realize that the appreciation factor of real estate always happens. It may have down cycles. We saw that in 8 and 9, but it came back with a roar, and it came back much
Yep.
faster than the stock market did. And so,
Yep.
uh, over the long haul, it's going to trend up. It's set it and let it ride. As a passive investor, your homework should be in finding a sponsor you know, like, and trust, and have some history with them. And then it's just a matter of autopilot. And truly, the worst asset I've ever been involved with, and I've been in probably 25, 30 syndications as either a GP or an LP. The worst one returned 0%.
It didn't return anything
It didn't
negative,
return.
though.
It didn't. But it didn't return anything negative.
Yep.
And and so as an average, I would say as an average as a passive investor over the, I don't know, 12, 15 that have gone full cycle, I have averaged 170% return. So,
And I always find it funny too, Randy, how us as in the real estate business, how everything we do, like we have to multiple times, and my listeners get tired of me talking about this, I'm sure, but for we on several different occasions throughout the process have to disclose,
sure.
and yet you can go buy stock of a soda company that could go broke tomorrow. They go broke. Bernie Madoff runs off with the money, and nobody ever disclosed anything. But we yet have a hard asset that's tied, like
Sure.
a hard asset that's tied to this investment, and people just, and it's like the SEC just loses their mind.
Well, and we're never taught this stuff in school. And
That's
very
right.
few people that grew up knowing somebody that their father, mother, aunt, uncle, relative, neighbor did real estate. It's becoming
Yep.
much more in vogue today, and I think our children will be in a much different situation. But again, I was trained and spent a lot of time in a lot of different classrooms, and I got a lot of training on finance and net present values and all those rates of returns and all that stuff, but never was real estate mentioned as
Yeah.
a portfolio diversification strategy.
Well, and think about, I've always talked about the moat that financial companies, big financial companies, have built around the finance industry.
Mm-hmm.
And I think one of the drawbridges that goes into that, on the other side of that moat, is school. Always has been.
Sure.
They're how many times, I remember in economics when I was a senior in high school, we did where we did the like the phony, I don't want to say phony, but the trading, like the hypothetical
Sure.
trading, where we traded stocks
The
on
modeling.
paper to see
Yeah.
where yeah. And I never once heard anybody say during that class, teacher or guest or any other student or anything, say, look at what real estate can do on a not only a cash flow basis, but then on a leverage basis, and on all kinds of different things you could look at. Now, again, I don't. I feel like some of that stuff is led by the financial industry, because they're trying to, the more money they keep under
Yeah.
control and behind that Series 7 license, the more
Well,
power
I'm in
they
the
have.
medical profession, so I tell one of my other high net worth individual friends, I tell him, I said, so I'm in the medical profession. When you go to a surgeon, what do they tell you? Surgery. When you go to
Right.
a therapist, what do they give you? Therapy, et cetera. And so when I go to a traditional money financial advisor, they've been trained in stocks and bonds and portfolio
That's right.
diversification and making sure you have a diverse portfolio to protect you from all the different ups and downs, blah blah blah. And I'm not
Yep.
criticizing them. That's not bad. It's worked for a lot of people, but it excludes an awful lot too, and just uh, is just part of that mindset that people have to. I was asked to be on this guy's talk about. He's on an annuities program. He sells annuities, and he's all into annuities, and he just couldn't get his head around real estate at all. And I'm like, wow, you're a smart guy, and
Yeah.
he just it was just foreign to him because he'd never been trained that way. And
Yep.
as people
Yeah.
as
And
people begin to understand themselves, understand the model, that's how you de-risk your investment,
yep.
by educating yourself in anything, especially in this space.
Well, definitely. And I mean, how much de-risking does one do in this space, where you just learn, you try to learn, you try to jump in, you try to get in masterminds, you try to get in this, that, and the other, and
Yeah.
see what things are going to benefit you the greatest. But so let's talk a little bit. So you said you're in the medical profession, and I know from that perspective, I got to tell you, my avatar is an anesthesiologist. And so
Wow.
it's very intriguing to me, because we look at, I look at several different angles of that. So I gotta jump in with the questions that I ask most of the time when we have people who do actively passive invest, and especially one that's in the medical field. Because I think I didn't realize that you were in the medical field. Are you a doctor, like MD, or
I tell my wife and my children that I'm not a doctor, but I work in a hospital. So no, I'm not a doctor. I'm an administrative type. Uh, I'm an
gotcha?
administrative
Okay,
type that handles a bunch of the business, core business stuff. But I deal with
so
doctors every
you
day.
really So you really see it from both
Oh yeah,
sides then, from the perspective of, hey, these guys, and one of the reasons why, and this is just a little kind of token for the listeners out there that are trying to build their avatar, or somebody's trying to figure out what their what their ideal investor looks like. And one of the reasons my avatar as an anesthesiologist is because it's simply because of the time. I realized early on, I've got a couple friends that were anesthesiologists, and the one thing I noticed was they didn't have a lot of time. They didn't have time to do anything. Like, they barely have time to sleep at night. They barely have time to have any type of a family life. And I thought, okay, so that's the kind of guy that I want, somebody that makes. And so my kind of tagline became, turn your massive income into passive income. And
nice.
so, and that was what led us to that. So I got to ask, as a passive investor yourself, what is one of the first things you look for in an operator prior to investing with them? Now, maybe you're probably at the point where you're reinvesting with some of these guys.
Sure.
But like, if you had just a new deal, somebody presented you and said, hey, Randy, here's this deal. What are some of the first things you look for?
It's a great question, Casey. Thanks for asking. So I think, I look back to my first one, and I'm probably at a little bit different season now. I remember back in the day when my first question when I went to one of these meetups is, "Gosh, how do I find a deal? How do I find a deal?"
Yeah, isn't that the truth?
And
Yes.
and now, fast forward 8 years, I probably get at least one or two a week in my box. Somebody wanting me to invest. Because
Yep.
once you get on the list and you get in networks and you get in meetups, so
All right, let's jump forward right there. All right, time out. Let's jump forward right there. So you've got in your inbox, what makes you open up and look at the deal?
first,
Let's jump
yep,
forward. We know. Yeah, I want to hear that part.
to make me versus delete, and I'll tell you, I delete 90% of them. The only
Sure.
ones I'm even going to probably read are the ones that I've already got a relationship with or have been recommended by somebody else, somebody
Okay.
that I know,
So the
somebody that I
relationship
know.
is really,
Yeah.
so at this point in your investing, passive investing
So I have,
career,
as an
or
example, I have reached out and I have tried to, I'd say, branch out into a new asset class, industrial, and
okay.
I'm looking for to invest in my own money, my own time, not as an active, but as into a industrial syndication. And for your listeners, industrial is just another asset class within commercial real estate. They focus on manufacturing, warehouse facilities, et cetera. They're just industrial sites across America. And so, why do I want to get in that space? I want to dabble my toes in it, only because it's the other only really performing asset class besides multifamily and
As
industrial,
of right
as of
now,
right
but I'll
now.
tell you, you know, the industrial, man, it held on by just hopes and prayers. Like when your gas tank is on E and you're 10 miles from a gas station, and you get there and you're like, industrial about 7 or 8 years ago did that. And I mean, it held on, and I think they were scraping the bottom of the barrel trying to hold things together. It's a little bit riskier asset class, in my
It
opinion,
is.
but you're right.
It is.
As of right now, but your risk is also your risk is also, you know, kind of paid back in reward, because it's the one that's performing now, and not only, and when it performs, it kicks
Rocks.
ass and takes names
Yeah.
and runs. But when it doesn't, it does exactly the opposite. It scrapes the bottom of the barrel and just holds on for dear life.
So back to your question, though, Casey, I got a referral from somebody, and who had done one and had success with this person. And I reached out to that syndicator then personally. They didn't solicit me. I reached out to them and I had a long conversation with them to start it off about their investment philosophy, where they were currently investing in, what their track record was. Can you show me some of your past deals? I want to see 2 or 3 referrals that I want to call some of your investors personally. I need their names, addresses, and not their addresses, but their phone numbers so I can talk to them.
Okay.
This actually happens to be a fund, but if it wasn't in a fund, if it was a specific asset, I would actually go visit that asset. I don't care if it's in Topeka, Kansas, or where it's at. I'd want to get a flavor the for the submarket in that space too. And it just happens that this one that I've actually settled on, and I'm just really dipping my toes in, as you said. I'm making a very modest investment of my own money, but I do like the asset class, and in the South where I'm at in Houston, I mean that asset class is just booming. They're just crazy.
Yeah, and that's the other part of industrial that I think a lot of people forget about is it's even, and I'm going to say this, and it's the listeners are going to be like, what? But to me, industrial is even more location dependent than almost retail. Just because, and I'm talking about big location
Right.
dependent. I'm not talking about street corner or somewhere. I'm talking about like in the country. Where is it located
Yeah.
in the country? Because it basically industrial has to be centered around workforce. It has to be centered around jobs, and it has to be centered around manufacturing. So there's a lot of things you look at.
And another risk there too that I'm sure you remember is the tenant, right? So you only have a single tenant generally. Yeah, you have a very
Yep.
large building with a single tenant. So the sponsor has to dive into the tenant's balance sheet and their ability to maintain the asset, because most of them are triple net leases, and that just means the tenant pays for everything. They pay the taxes, they pay the maintenance, they do everything, and
Yeah.
you really have
Yeah.
to
Triple net.
understand the tenant's balance sheet and their strength. As you said, during the COVID, there's a lot of retailers that went, really got in a hurt. And if their
Yep.
warehouses were owned by somebody else, that had to have a bite in the cash flow. So
Yep.
it's another complexity.
All right. So let's go back I want to rewind in your mind to your very first investment, like the first time you ever dipped your toes in, even if it was multifamily or whatever
Yep.
it was, but one that you invested as like you were a capital investor
Yep.
and took passive income. What were some of the things that you recall about that, and what were some of the things that really made your ears and eyes perk up when people started talking about it?
So that very first one, everybody, it's like your first investment, your first child. I remember that one very vividly, and great remembrance of it.
First child, yeah.
It's 2014, a different time period. So I was attending at that time. I was trying to educate myself. Back to the other criteria of educate yourself. I was attending one of the
Sure.
large national educational arms, and I remember having lunch with these guys and saying, how do I find assets to invest in?" And to where we started, and they said, "Just hang around here, and you'll see." And people will ask, and it's true, because they will. If you just ask and make it known that you are interested in investing to
Yep.
people and have business cards, they will start to come your way. Trust me. Uh,
Yep.
it may be a week or a month, but they will start to come your way.
We were at a conference about 6 or 8 months ago, and I was there with my buddy, and he put on one of those pins that said passive investor or something like
Did you
that. And I
really?
said, dude, I said, you don't want to do that. I promise you. I said, it'll be like piranha and sure enough, man, a year later, he's still getting calls.
It's like flies on stink, man. That's
Yeah, I was like, gosh dang, dude, you just want to stick your hand up in a room full of, oh my Lord. Anyway, he was tickled with it. He was happy to get it done. So
I'm sure he had a lot of
anyway,
opportunities.
He did. Definitely got some offered to him for
But
sure.
I found the guy. I found an acquaintance that I knew from Houston here who was getting started in my time, about the same time. He'd been in about 6 months before me, and I knew him, and I knew so kind of we connected because he had a corporate background like I did. He was from my season of life, meaning he's old. Uh, and he was just getting started, and he had been trained by this organization that I was now in as well. And so he found this asset that had a great storyline to it, and I bought in. And then I further de-risked my investment because I didn't want to put in a full $50,000. I found a friend, and we formed a trust, and we each put in $25,000
Okay.
each to de-risk it even further because I was so risk adverse.
I love the fact that you said there's one word in there you said that just I don't know, man. It really made my marketing mind go just berserk really quick was when you said the word story. The asset had a good story behind it. And that's man, I'm really diving in on some of this story brand and how to tell stories and like the presentation secrets of Steve Jobs, the book by oh Carmine Gallo, I think is who wrote the book that I'm
Mm-hmm.
reading right now. And man, that's all they talk about is the stories behind this stuff and how it makes the mind.
You have
Anyway,
to. It has
go
to be
ahead. I'm
real,
sorry.
and nobody. I mean, I can read a prospectus. You can read a prospectus from a mutual fund or whatever, or you can read about it. But you want to hear the real life story, which is why it's a good asset. What's good about it? What do you like about it, etc.
Yeah.
And
The villain is the 80s interior
yeah,
that you want to just completely obliterate and put something new in and make this asset crackerjack top notch and anyway, man, that's cool.
and once
That's
you
awesome. I love that.
and once you
That.
somebody told me a long time ago, Randy, nobody's gonna really embrace your dream because it's your dream, it's not theirs, but they will
That's
embrace your
right.
passion, and they will embrace your ability to communicate. So, and everybody can do it because it's a hard asset. I mean, it's a physical asset, so
Yep.
you can tell the story. We're going to improve the rents, and how are you going to do that? Well, we got comparative data, and this guy's got a track record, and he's been in this submarket, and we got an operating company that's been there. Blah blah blah. Um,
I'm always intrigued with these 150 slide long presentations for for investors to sit through and I've sat through several of them just to try to pick high
sure.
points, low points, what I think were just from the simple fact of saying, hey, how does my stuff compare to that? And man, I'm like, I need a nap. I mean, I'm tired. I get that, but hey, tell them what it's going to do. Tell them what it's going to return. Tell them when they're going to get their money back. Tell them they can trust you. Tell them those things, and then break it down into a story of the town that surrounds the asset, what the asset's going to do, and what your hopes and dreams are for it, and be done with it. Like
and
150
answer
slide long,
questions.
hour and a half, correct, and then say Q&A. What do we got? Well, and because that's what they want to know. You can't put together a 150 slide long presentation that takes an hour and a half and anticipate every question that's going to be in a room. You put together the story, make it work, and go from there.
And conversely, you can't have a PowerPoint with 4 bullet points on it on every page. I mean, it's got to tell the story much more about the submarket, the sponsorship team, the business plan, and if you hit those major elements, like you said, Casey, I think people are going to be a little forgiving if it's the greatest PowerPoint presentation, but as long as you've got a
Oh
story
yeah,
to
yeah.
communicate.
Well, the book about Steve Jobs' presentation secrets. I mean, they talk about how just very basic his PowerPoints really. I mean, Keynote is what he used,
Yeah.
not PowerPoint. Some Mac people like myself get freaked out when people
Well,
start
he
talking about Steve
despised
Jobs using
PowerPoint.
PowerPoint. That's
He
right.
despised
Yeah.
PowerPoint.
But it's so interesting to me the things that people really do hang on to when they make these investments, and most of the time, believe it or not, I'm going to say 70% of a person's decision to invest is based on the first 30 seconds they talk to a principal or talk to a sponsor. And it's really boils down to most people don't do what you do, Randy. Let's just say
Yeah, I
that. I
agree.
mean, it's not that anybody has anything to hide or anybody has anything to do, but most people are like, hey, here's my money, invest it. And I've also been a student of the adage of return of capital is almost more important than return on capital.
Sure.
Like you said, you remember that one that made 0%, but it didn't lose anything. And
Yep.
wow,
There's another whole podcast behind that story as to why that did that way, and the relationship with the sponsor and how he did such a great job. But the other point is people. I have high net worth individuals that they'll throw money at me and my investments or you or anybody else. But it's just like, you know, I say I throw money at my mutual fund, my employer, right? I put it in,
yeah,
high growth or low growth or mid market, whatever. And to me, that is speculation
yep.
versus investing. And what I try to encourage people to be is an active passive investor, at least till you get comfort with a couple of sponsors and know them and you can trust them.
That's right.
Be an
And then,
active and
like you
passive.
said, once you and I'm not even against going to the asset maybe the first time, and once that operator, you see how efficient they are and that they've run good, and then maybe the next time you're like, yeah, man, I did 50 last time, we'll do 50 again this time or whatever. And then maybe you just start building that comfort level and that relationship. And the other part that I've run into that investors freak out about is the idea of, when am I going to hear from you next?
Mm,
That communication. You let people know that you're honest, you're going to return their capital, they can trust you, and you're going to be available for communications. And that's even on a scalable communication where you say, hey, we're going to hold a biweekly update.
right.
And sometimes it's hard to talk about things when you really don't have an update because as slow as some of this stuff moves. But just
Yeah.
put yourself out there and say, hey, this is when we're going to communicate and make it happen.
Well, and that's obviously something your listeners, as new passive investors, you want to give me examples of your communication. How often do you communicate? You're right that you
Right.
should get, as a passive investor, you should get monthly written communications from the sponsorship. My
Yep.
investments, we have biannual, or every 6 months we have a webinar where we
Yep.
update the investor pool. We invite them to it, or I send them a video if there's not a whole lot to say. And like you said, I mean, year one in any investment, there's a lot to talk about during transition and how we're doing. Year 3 or 4, uh,
Yep.
as long as I mean, I got one that it's doing so well, I don't even read the monthly letters anymore because
Yeah.
it
Yeah.
would take
Well, and
6 months for it to go bad.
that's right. And that comes along with your trust levels of saying, confidence in the operator. For instance, I mean, you have confidence that operator knows what they're doing. Like you said, it's going to take 6 months to go bad, so you're going to hear something surely within that 6 months. But what bothers me a little bit about some of this right now, the way that the landscape is set, is there's a lot of bridge loans out
Mm,
right now that are going to come to fruition at some point. And there's going to be some principals and some sponsors that are going to have some very difficult discussions with their investors. And that's what again, I'm not finger pointing because it can happen
sure,
to any of us. I'm not like, oh, yeah, I'm going to stand over here and laugh, but I'm going to pay very close attention to how those discussions are handled. And the thing is that every time I've ever called somebody like on the real estate sales business and said, hey, I got some bad news. Somebody just backed out of buying your house, right? And the people are never happy about that part, but they're not upset with me. And so you have to figure out and say, hey, listen, this deal just didn't work out like we thought. We had multiple people move out. We had such and such burned down. We got such and such natural disaster. Nothing, it just didn't work out.
sure.
And here's your money back. I'm sorry. And it just seems like investors have more respect for people
Well, and I
when
think,
that's
just to level set for your audience too, I mean, I think any general partner, uh, if you do this long enough, is going to run into I won't say a bad investment, but one that didn't meet pro forma.
That's right.
I've only had the one that was zero, but the second worst one, returned 30% in 3 years. The second
So
worst
we
one.
really returned 10%. I mean, returned 10%
Yeah,
annually. I
at
mean,
10% annually. That was the second
so
worst performing deal I've been in.
yeah.
And,
Yep. The delta in your first and your second worst is pretty damn good. If you, I mean, considering what other alternative investments there would have been.
absolutely. Absolutely. And I never looked at it, what the market has done over that time period, but I guarantee you I'm much more comfortable in the hard assets that we're in as a general partner and in multifamily than it would be in stocks and bonds. But
Sure.
that's my investment portfolio. But I think
Sure.
you're absolutely right. I really like kind of the way you put it. Now I have repeat and as a passive investor. When I'm investing, there are people that will send me a deal, and if I got money, I barely look at it. I'll just send them the money. You can call that criticism, but it's also just comfort level of having
No,
done
but
multiple
it's
deals with them.
business too. It's business too. You
Yeah.
can't all that stuff takes time, and time ultimately at the end of the day is money, but it's infinitely more valuable than money, but it still is money nevertheless. So all right, Randy, listen, as we're running out of time here, I have a couple questions we ask every guest that comes on the show. And first of all, I want to thank you for coming on the show today, and I really enjoyed the discussion and kind of digging into your brain there a little bit behind the scenes and seeing just what makes, because we're always interested in what makes potential passive investors tick,
Sure.
if you will. What makes one deal better than the other, and like I said, listeners, I would really dig in on some story stuff if that's really you heard the man right there. I know it was just a passive sentence for him to say, but you heard it right there. I mean, the storytelling, the story brand, the story, everything. So anyway, all right, Randy, what is the best book that you've recently read or are currently reading?
The best book that I have read or are currently reading. I'm turning to my shelf. I would always start out by saying that my favorite book of all time is the Bible. I do person of faith, and I think um, is very good. And obviously, I spend a lot of time in that each day. But from a business real estate perspective, I was just listening up to the Passive Investment Made Simple by Anthony Vincino and Dan Kruger. So I've recommended this book before on my newsletter. I haven't got all the way through it yet, but I really like it. It's really attracted towards the passive investor and their mindset. So
Sure.
I recommend that to you.
Well, that's it. That's it right there. I mean, that's what we were trying to dig into, and I think you exhibit quite a few of the signs that I know I look for in passive investors, and I know that probably freaks you out that people know that stuff or see, but a lot of your methodical ways of thinking are what lend their way to you being a very effective passive investor, if you
I
will. So,
send this book to some of my investors and another book on passive investment made simple. You and I want investors that are educated and know the risk.
that's right.
Hi, this is Casey Brown, host of the CashFlowPro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making CashFlowPro part of your day. Now, back to the show.
That's right. Yeah, because the worst thing you could do is have somebody that doesn't really understand, doesn't really know, doesn't really, I mean, just thinks they're like, you mean I didn't buy that? No, you didn't buy, and you don't want that.
Right.
That takes time. That takes way too much of every energy and everything to efficiently operate. So, all right, next question: what is a dream vacation that you have taken or hope to take?
Dream vacation that I would say my wife is not in earshot, but my one of my dream vacations in the past have been a golf junket with a bunch of guys going to play golf for about 4 or 5 days and at some very nice golf courses and have done that a couple of times. My dream vacation, hopefully, is next year. I really hope to hit Hawaii. Never been to Hawaii yet, and that's really on my short
Man, I
list.
get that all the time on this show. I don't know if it's that I have a lot of people on the West Coast, but man, I get Hawaii. I'd say from a daily standpoint, I'd say probably at least 8 times a month.
Wow.
So, and I'm just and people that have either been and say, hey, yeah, that was my favorite, or people that are like, hey, I want to go, and I'm like, I just never. I guess in the eastern half of the United States, it just doesn't register because it is so like you almost lose as much time going there as you would to Bali or
Oh yeah,
or somewhere in Asia,
you
somewhere in
do.
Asia, really, for that matter.
Yeah.
Because coming from where we come from, but because we're like, oh yeah, we're going to head down to Cancun, or we're going to head down to the Bahamas,
Yeah.
something that's on this side of the country. But
Makes sense.
Well, awesome. Randy, I know you had told me before the show how people could get in touch with you, but I'd like for you to tell the listeners how they can get in touch with you. And I know you do some like, I want to call it crowd investing as well, right? Where you take like maybe 5 people's 50,000, then turn around and put it into
Sure
an investment found or something like that. So go ahead and tell the listeners how they can get in touch with you if they want to learn more.
Casey, again, I just want to thank you, man. It's been a real pleasure. Great to get to know you a little bit more than we have already. And for the listening audience, I'd really enjoy talking to any of them about almost anything real estate wise. And the easiest way to catch me is on my webpage. It's invest-ark, invest-ark.com. And there's a contact us on that page that you can catch me anytime, make an appointment at Calendly. I'm out on LinkedIn as well, Facebook, and happy to talk to somebody.
Awesome.
I'm a coach.
Awesome,
I'm a coach for Rod Khleif's organization today. And somebody asked me, will you spend, will you give me some time? I was on a meetup, and they said, and I said, yeah, I will. I'm not going to give you unlimited time, and I generally mean that. There's been so many people that have built into my real estate education that I truly want to give back. And so reach out.
Yeah. Awesome, man. That's great. And Rod's a good guy. Rod, I've talked to Rod a few times at some of these conferences and stuff. And man, yeah, anybody that's looking for a good solid individual who has truly earned his way up from the bottom.
The guy is always on. I don't think he ever sleeps.
Man.
He's just always on.
He just unplugged here a few weeks ago and went to, I forget where he said he was going, Belgium or something.
I did see that too.
It was pretty. Yeah, I mean, he's a stand-up dude. I mean, straight up. So, all right, Randy, well, thank you so much. And listeners, thank you for taking the time to spend with us today on the CashFlowPro podcast. Please head down and smash that subscribe button. And while you're there, leave us a review and type a review. Make sure you type that review out so that others may know what you enjoyed about our podcast today. And I hope, Randy, you have a good rest of the day. And listeners, I hope you all have a good rest of the day. Thank you so much for listening.
Thanks, Casey.
CashFlowPro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.